Hey everybody, welcome back to Investing with Wesley. On today's episode, I want to share with you a success story that I had with helping one of my clients. Now, this is creative finance at its best, so I really hope you get something out of it and can change the way you think about certain investments and certain ways we do things as a community. So, let's get into it. Okay, so obviously I can't post and give away client information and privacy and that kind of stuff. What I can tell you is the need to know detail. I had an elderly client reach out to me who was very concerned with their cost of living. You see, they were 75 years old and already retired, living off of their pension. What they didn't know, however, is that their mortgage was about to triple overnight. See, 20 years ago, when everyone was taking out mortgages and second mortgages, this particular family took out a 20-year interest-only term on a home equity line of credit. Now, this home equity line of credit was only $100,000, but for 20 years, they've only been paying interest and not paying principal whatsoever. Finally, at that 20th year term, did it convert into an amortization period where now they have to pay the interest and principal. Now their regular mortgage amount was only about $1,300 per month. But with the increase of this interest plus principal, it went to $3,300 per month. Now considering they had no other form of savings and they only were living off of their pension, which was $4,000 a month, it's safe to say that pretty much all of their money was going to the mortgage. This client had to scrimp and save everything else just to afford their cost of living. So they came to me extremely hopeless, thinking there's nothing that they could possibly do. And I told them that they have a couple different options, believe it or not. The first one, and probably the most obvious one, is to just refinance into another 30-year fixed. It would refinance their existing mortgage and the home equity line of credit, lowering their interest rate and extending the term, obviously lowering the payment. Now, unfortunately, because of the cost of living situation, this client was forced to skip a couple payments on other debts and liabilities that they had. So their credit was pretty bad. Nevertheless, they could have refinanced, got a 3.5 interest rate, and turned their $3,300 mortgage into an $1,100 mortgage, that simply. Now, the second option was an idea that my client had themselves. This idea was to refinance the total debt into another home equity line of credit and just again pay interest only for 20 years, considering she didn't think she would make another 20 years. So worrying about the increased payment 20 years later wasn't really an option for her. Now, I shut down that idea extremely quickly because obviously no one knows when they're going to pass away and no one can pretty much guess life expectancy. As well as, even if those things weren't a factor, the interest rate on her lower credit would have been 7%. So refinancing her mortgage and the home equity line of credit into a new home equity line of credit at 7% would have put her monthly payment at $1,400 per month. Yes, it's better than the $3,300 she was spending, but it doesn't beat the 30-year fixed option, so why bother? So after meeting with this client and then sitting in my office thinking of a potentially better solution, I decided to run the numbers and offer her option number 3. Option number 3 is the refinance option. However, instead of just refinancing the mortgage and the home equity line of credit like option 1, I said that we should cash out refi the entire equity that's in her house, saving the 20% that you need to avoid PMI. I then suggested that we should take that lump sum cash and throw it into a variable annuity. Now, I would have recommended that we just threw it into a safe diversified fund and she live off the interest. However, this client is extremely market averse. Now, also, if you know anything about annuities, I was recommending a variable annuity, which again is still linked to an index or investing in the market. However, I was recommending that we put her money into an AIG Polaris variable annuity. Now, I'll put it up on screen, but you can see here that Polaris offers you 3 different payment options. Options 1 and 2 having a maximum annual withdrawal amount and then a payment insured protection on the back end. Basically, with options 1 and 2, you're allowed to take the greater percentage, and then when that annuity runs out of money, you get the lower percentage guaranteed for life. Now, obviously, because of how the markets have been behaving and me personally believing we're due for another correction more severe than the COVID pandemic recession, I elected to recommend option number 3. Option number 3 was a fixed amount for life. So it didn't matter if her investment value went up wildly or crashed and turned to zero. She was guaranteed to get 5.25% of her cost basis for the rest of her life. Now, you might be thinking to yourself that that sounds like a whole lot of extra work and it's probably not all that worth it. You might even be thinking that I just recommended this so that I could collect some sort of payday. And let me just stop this thought right now because I didn't profit from this deal at all, not even a single penny. This client started out with $240,000 in mortgage debt between the original mortgage and the home equity line of credit. The market value of the home that they were currently living in was $700,000. Now, $700,000 minus the 20% gives us with a loan value of $560,000. Now, subtract the $240,000 worth of debt that the refi was paying off, you're left with a cash balance of $320,000. Now, we threw this $320,000 into this variable annuity. Now, although the brochure advertises 5.25%, there's some tweaking that you could do. And with that tweaking, we managed to get that fixed for life percentage all the way up to 6%. Meaning the annual dollar amount that they could withdraw is $21,000 or $1,800 per month. Now, obviously, we have a much bigger loan and a much bigger mortgage now. So what's the ratio between mortgage and income? Well, as I said, the new loan and the new mortgage is $560,000. Again, this client doesn't really have all too good of credit, so they got a 3.5%, which all things considered is still pretty good. Nevertheless, this put their mortgage amount at $2,515 per month. Now, if you were paying attention, you'd know that the $1,800 that they were getting per month from this annuity wouldn't pay for that mortgage outright. But with this new $2,500 mortgage minus the $1,800 that they were receiving from the annuity, gave their net mortgage, or what they would actually be coming out of pocket at only about $700 per month. Now, I'll admit that this sounds like complete overkill, especially to only save this client $400 a month when it comes to their mortgage. Because option one, just your standard refinance, was $1,100, and this option is a out-of-pocket $700. And the only reason I recommended this option in all of its complexities over just your standard refinance is this client is already retired, living a very fixed income from their pension. So any amount of money saved is worthwhile. Sure, it was extremely complex and it would have been way easier and way quicker to just refinance and choose option one. But however complex it needed to be, I was able to save my client an extra $400 a month that they can use on whatever they want. I hope you got value in this video. If you did, please remember to like and subscribe as it really helps push this channel out there. I also hope I helped inspire you to think differently and creatively when it comes to dealing with your own finances, and that no matter how complex a solution might seem, if it saves you money or reaches your goals that much quicker, then it's definitely worth it. If you ever had a question, comment, want something addressed, or even wanted to recommend a topic for a later video, you can reach me on either my dedicated Facebook or Instagram account. I don't post there too often, however, I'm always on there scrolling, so that'd be a great place to reach me. Either way though, the choice is yours, and I'll see you in the next episode.